Hi, I'm Sidhartha Dash, or Sid Dash. I'm the Chief Researcher at Chartis Research, and I'm going to take you over some of our views on the structural shifts in ALM and credit ecosystems. Each of these uh, are large, complex, and rapidly changing ecosystems, and they do have significant interconnect in the banking book, for instance, um, and they impact each other significantly. However, I'm going to try and very quickly take you over some of our perspectives on how they're changing, what are the big structural shifts, and what you probably want to look out for in the next few years. To start with, first of all, ALM is a complex set of interlocking analytical and operational activities and has been growing in range, diversity, and set of functions that are required. Sometimes, sometimes equally, there is a little level of terminological inexactitude in this area, and we can often have significant misunderstandings just based on terminology. However, let's look at the ALM landscape broadly. From our perspective, our key sort of dimensions and key analytical environments include the sort of first and foremost the focus on cash flow generation, aggregation, and operational analytics, expanding then into behavioral modeling, which obviously impacts the nature of cash flows that you are forecasting, you're thinking about. But also, more fundamentally, as we'll see, behavioral modeling is in some ways, particularly in heavily retail oriented environments, it is in some ways the it is in some ways business modeling. It's much more, it ideally captures and encapsulates the nature of the business, and we'll examine that in more detail as we go along. We also then we have the capturing the cost of your funds, mapping the cost of funds specific business lines, specific products, et cetera, and moving onwards into developing your hedging strategy and your execution mechanics for that. We then move to thinking about forecasting your balance sheet into the future, and then managing your balance sheet, optimizing it. And there are many different angles to this whole balance sheet optimization. It could be largely a financial optimization, leveraging data and statistics that you have accumulated from your operational elements, or it could be a very operationally oriented optimization in conjunction with the regulatory environment. What strategies does the regulatory environment actually allow you to pursue, and so on and so forth. So, in principle, as you can see, it is a large range of activities. How it all comes together is very, very specific to individual financial institutions and the uh, and the ecosystem in different geographies. Uh, as we all know, the ecosystem in the United States is very different from the ecosystem in Europe. The United States is a very, very long tail of middle-sized to small banks. This considerably changes the way financial institutions think about balance sheet management in that context. In other geographies, it is very different. And when we think about ALM analytics, we can see it in multiple different dimensions, if you will. As I mentioned before, liquidity and behavioral analytics, it can often be seen as a subject, as a whole art and science in their own right. And in some ways, they can be seen as business modeling, particularly in areas such as banking, where particularly with the retail banking with a strong retail focus, the whole behavioral concept becomes the heart of business forecasting or business management, if you will. the flip side of that is the whole fund transfer, internal and operational ALM management, mapping it to your products, mapping it to your business lines, figuring out what your business floors are, what your product pricing strategy should be, and so forth. And finally, deciding your balance sheet analytics. So as we have seen here, it's a broad, ALM is a broad church, many different uh, possible options and combinations that are available. We feel that each of these areas is increasingly more mature, and each of these areas is increasingly a discipline in its own right. And as we cover ALM and we look to cover that annually, if you will, we look to focus on each of these individual areas in greater depth, with specific focus, and we increasingly look at the institutional landscape, looking at the different approaches to behavioral analytics, for example, and so forth. So within this structurally evolving environment, there's been a bit of a regime change. The regime change, we think, has happened due to obviously the shift in interest rates. The shift in interest rates has brought out, we think, a fundamental refocus and a renewed interest in the whole ALM disciplines, if you will, the whole set of interlocking disciplines around in the ALM area. There's increased focus in that, largely because of the rise in interest rates, but also because of liquidity events. We also think that it's really important for regulators and financial institutions to not only focus on pure banking products from a liquidity or behavioral risk event, but also to think about alternative products, products which may also contain run risk. And the example of Credit Suisse suggests that run risk can be embedded in not just in deposits, it can be embedded in wealth management products, in a variety of other environments which may look like and may have similar or structural similarities with banking products, but not exactly the same. We also have seen digitalization and the ability to move capital around very quickly is also changing the behavior, particularly of institutional and large high net worth individuals. This essentially means that financial institutions have to rethink a lot of their behavioral modeling ideas and concepts, and need to rethink how they build liquidity metrics. They also need to rethink the way they bucket their customers. Which are the customers that are likely to leverage the new payment and market infrastructure? Which are the customers less likely to implement it, and so on. And finally, we think institutions need to pay more careful attention to the T's and C's that are embedded inside their contracts to think about where the run risk or even partial run risk can actually come from. As I mentioned, behavioral modeling, particularly in retail-oriented institutions, is effectively business model. You need to understand your counterparties. You need to understand, financial institutions need to understand how their counterparties are going to behave. And we think there has been a structural regime change in that behavior, largely sort of stepping from the nature and interface that retail customers have with their financial institutions changing radically. That interface is increasingly digital, and hence it's important to rethink their behavioral frameworks, if you will. There are in certain geographies and markets, there is a wealth of data because there are capital market analogs from which you can extract and get some implied behavioral statistics. But nevertheless, behavioral modeling, in our view, is a central aspect of how and how to build and manage uh, the ALM framework for most institutions going forward, most retail-oriented institutions. It has significant consequences for non-retail institutions as well, but the the strategy impact is probably the highest in retail-oriented institutions. With that, we take a little bit of a swivel away to a different, uh, different, uh, different, uh, different but highly related ecosystem, if you will. We've been arguing for the last several years that there is an ongoing shift in the architecture of lending and uh, credit risk, if you will. Who assumes the credit risk? Which types of institutions assume the credit risk? How is credit risk being structured? Has been changing over time. In many ways, the current market disruptions haven't necessarily stopped that change, but they have in some ways even accelerated it. So, what is this change? There are two big primary structural shifts. The first of all is the ongoing shift of credit risk away from the banks to non-banks. Some of it is obviously the impact of 2008 regulations. Some of it is simply appropriate shifts. Long-term credit ideally sits with sources of long-term capital, which probably comes more likely from insurance companies rather than banks. But nevertheless, there is a variety of reasons. I mean, the 2008 driven Basel regulations have been probably the most powerful reason, but there are other market structural reasons for the shift. Nevertheless, whatever the reasons for the shift may be, what we are seeing is a big structural move away to new types of firms, new organizations, and a very broad move away from banks, if you will. Equally, on the banking book, we see a greater formalization of the credit models. In many, many ways, the accounting standards, IFRS 9 and CECL, have wrought a revolution uh, in as well as other forces as well. But fundamentally, what we are seeing is a greater formalization of banking books mathematical code. And the surrounding technology environment around it, standardization of scenarios, standardization of scenario testing, standardization of the market environment around it, standardization of the simulation frameworks, standardization of the storage. In many, many ways, the substructure that supports the credit analytics, the performance analytics, the all of that has been changing in the from a banking book perspective, and we're seeing a much more rigorous and structured mathematical core emerge, if you will. Like all emergence, it's this is a long, complex process, and at the moment we see it as a halfway house. These two elements, the shift away from credit risk consumption in the bank from banks and an increasing formalization, play and interact with each other in fairly complex and interesting ways. There are other dimensions of the credit ecosystem that we also need to think about sometimes. And one of the areas we think about significantly is the credit in the energy ecosystem, which we think is often a fairly underestimated dynamic. Uh, as we see the sort of shift from the banking book, the restructuring of the banking book, if you will, and a greater formalization of the core, We see early warning systems and credit portfolio management systems take center stage, or in many ways really make a comeback. We distinguish early warning systems in the sense that early warning systems from standard credit monitoring systems, in the sense that they often incorporate a broader view of the risks than purely credit monitoring. Many of the early warning systems in the Asia Pacific region, mandated by central banks in that region, often have an element of uh, looking at the fraud elements of rather than just the credit elements and so on. So what we are seeing there is an increased focus on looking at the overarching management information around credit and credit consumption, and to provide a more dynamic view of that to the uh, uh, to the management team, to the credit management groups, and enable them to restructure and handle credit risk more dynamically, if you will. Again, there's a varied set of tools available there, and what we are seeing also is the increasing leverage of both alternative data and alternative analytics techniques. Uh, Alternative data, everyone sort of realizes that. That includes also a broad range of operational data sets, which can be leveraged for operational and compliance data sets that can be leveraged for uh, more effective credit analysis. On the alternative techniques, we see a broad range, fundamentally transferring these operational data into more uh, mapping operational data into credit impacts, leveraging uh, graph techniques in certain contexts, uh, using option theoretic techniques to map a value of the firm asset level impacts into particularly illiquid assets, particularly physical and operational asset level impact into risk levels, leveraging option theoretic techniques to handle capital structure analysis. There's a broad range of new or newish analytical techniques to sort of look at credit risk, if you will. So, with all these changes in the credit risk environment, we also think the credit data markets have been undergoing a massive structural shift, uh, and we can see that with increasing and broadening of the data sources. We see this increasing intersection with compliance and control. We see credit units increasingly leveraging the broader data capabilities or broader counterparty, a more enriched counterparty views that the compliance unit can bring to the table, uh, or the suppliers to the compliance unit often provide. We also see many specialist providers who provide a variety of all data around operational elements, which can then be mapped to the credit profile and provide advanced warnings and risk signals, if you will. So as so in increasingly many of the credit data ecosystem have been growing rapidly. Uh, Part of it is, as we discussed, as we see a broadening of the institutional types in the credit space, broadening of the credit product types. That obviously is a strong driver uh, for for the expanding universe of um, credit data and environment, if you will. And we see that across the board. We see We see increasing availability of variety of retail type data. We see a much more enriched and SME data with operational elements to news and other external elements, if you will, SME counterparty data being automatically and across the board enriched with um, a variety of alternative and operational data sets. And of course, wholesale obligor data, which is increasingly available in multidimensional format. And then specialist business subsectors have been strong uh, growth and now increasingly uh, vectors of change. The CRE environment, the credit risk and fixed income data, and obviously the core loan business. And and we see the we also believe we'll see increased variety uh, in those who will sort of package the packages in which credit data is likely to come. We will see increased diversification and variety as operational data often gets integrated in a variety of different ways with core credit data. So in both the credit ALM and credit ecosystems, what we are seeing is increasing maturity of the subdisciplines that interlock to create these ecosystems. We are also seeing a very rapid growth in availability of data and increased maturity of the analytical frameworks that are leveraged in both of these uh, ecosystems and subsectors and sectors. So while ALM and credit risk analysis are often considerably different, they interact in interesting ways, but also they are undergoing deep structural shifts, roughly in the same direction: more analytical maturity, greater diversity in availability of data, and the need to manage entity, particularly your counterparty from a retail perspective, in much more detail, if you will. To that, I close.